Let's just get straight into that, and joining me to discuss those inflation numbers, I have Samir Gadio, who is an emerging markets strategist at Standard Bank. Samir, thank you so much for joining me today. Hello, Samir,
Hello.
Can you hear me?
Well, yes, I can. Yeah, sure.
Great, Samir. Now, let's get straight into it. Now, of course, tomorrow we're expecting that MPC decision. A lot of analysts believe that the MPR will stay at 12%, especially because of the volatility that we're seeing in the Naira. Is that a view that you share?
Yes, I think that's a fair assessment. I mean, obviously, inflation is still in single digits, and given the current base effects, is likely to remain in single digits in March and in April. But for the central bank, I think that's not really what matters at this stage. We've seen the exchange rate move upwards in recent days. On Thursday, the intraday exchange rate went up to 159.8, and then on Friday, the central bank had to sell dollars directly to the banks. So clearly, there is some pressure, which somewhat reflects the fact that foreign capital inflows have slowed in recent weeks. In such an environment, I just don't see the central bank cutting the MPR. In fact, the risks to interest rates are more to the upside going forward, I think.
Okay, now, of course, after the release of the January figures, we saw yields go down in the fixed income space. Now, should that MPR remain at 12%, how much further can we see bond yields go down?
Well, in fact, if you look at the yield curve, it's shifted up in recent weeks. I mean, the 10-year bond is trading around 10.6, 10.7% today, while those rates were at 10.3% a couple of weeks ago. So, and you have the same trend at the short end. So it seems that there is a correction going on in the market. I'm not necessarily convinced that the market will react intrinsically if the MPR is unchanged. But as long as the currency is under pressure, basically the perception will be that foreign investors may not either come back to the market now or may even exit for some time. So as long as this is the case, I just don't see how the yield curve could shift down. Now, the risk is that even though the MPR might remain unchanged, the central bank may decide to squeeze liquidity of open market operations in order to support the exchange rate. And that obviously would put pressure on the short end, so on T-bills as well as on bonds.
Okay, now, however, now, like, given the current data that we've seen in regards to the budget, now we know that, there may be less revenue available to fund that projected budget, which could result in increased government borrowing. Now, we've seen the MPC increase MPR in the past because of fiscal policy. Is that something that could happen?
Well, let's put it that way. One of the reasons why the MPC will not cut the MPR is because, obviously, of loose fiscal policy, and the fact that the oil price benchmark went up to $79 per barrel in the budget is clearly not a positive trend. But let's go beyond the budget. I mean, if you look at the federally consolidated fiscal position of Nigeria, it's still quite loose and perhaps balanced at best. I mean, Nigeria as a country should be running a fiscal surplus, but it's just not the case. And if you look at the excess crude account balance, it only stands at $9 billion, so 3.5% of GDP, while all exporting peers have a median of about 65%. So in such an environment, the fiscally sponsored liquidity will remain a threat to macroeconomic stability. And I think the MPC will keep that in mind, obviously.